Good morning, everybody. It is Memorial Day weekend, the very beginning, Friday, May 24th, 2019. I feel like a real broadcaster now. I went to Best Buy and got a Blue Yeti microphone after people were telling me that I sounded tinny and far away and nasally. The truth is, I'm from Wisconsin. I am always going to sound nasally. That's just the way that it is. I've tried to fix it by talking in an English accent, sounding like I was from out east, a little Baba Kennedy. And, that might have been down south. See, I don't get those I get those kind of mixed up. So in any case, hopefully I sound a little bit better with this nice new microphone. And we're going to do a bit of a round robin here, and some question and answer for Memorial Day weekend. I'm going to talk about a couple of things to keep in mind. One of the big themes I use is to scale in and scale out of positions. And I'm going to talk a little bit about how to do that again, because I think some people buy every 2% dip spaced by days rather than months, and that's not the right way to scale in. When your stock drops 2%, you don't jump and buy more. You have to have technical levels that you're watching and absolute value levels that you're watching. So I have actually updated, and it will be up by Monday, the very short list. We're just going to call it watch list from now on. And I've included a secondary buying level to make it a little bit easier for folks to know when to scale in. So we will get to that near the end. When I launch that, you will have to ask for permission to use it. It won't be a direct link. It'll be a link to a Google Sheet, and then you will need to be logged into Google and request access. And you need to either use the email that you normally use or a name that I recognize, because I have noticed the traffic on my sheets is way higher than it should be. So that means that there's a lot of folks who are looking at those who don't belong in either one of the groups. So we're going to set that up to be verified access. In any case, wait for the reds of their eyes is a blog piece that I wrote this week over at Fundamental Trends and at Margin of Safety Investing. And I talk about where this market could head next week. It looks like the 2,600 level is pretty possible. So that means, we don't necessarily want to buy every time the market drops, right? We want to look for those super oversold levels. And right now, the S&P 500 is not super oversold. Even if we look at it on a daily basis versus weekly, it still has further to go. So next week, we could see that very oversold condition down around 30 on the RSI. And that is what we want to be looking for, a number in the 30s. We see that money is flowing out again. We're at the end of a month. I don't know whether you know this or not, but I've talked about it before. The start of the month usually gets more of the inflows each month, and the end of the month usually gets the net outflows. I don't know entirely the explanation. It used to revolve around retirement plan contributions. I think it might be partially, algorithmic reinforcement at this point. The algorithms know that it happens, so they reinforce it. I don't know why it continues, but it does. Usually the first week or two of the month is better than the last week or two of the month. We're experiencing that in May. So I think that next week, which will be a shortened week, only 4 trading days, if you see a blow-off on Wednesday, Thursday, or Friday morning, you may want to establish some positions if we get towards that 260 level on the SPY. So right now there's a technical battle going on, and if it breaks below I think it was 2808. So 280.8. If it finishes below that today, that would be indicative of the market going lower next week. We'll see what happens. We've been getting the late rallies in the day. We'll see. Some interesting information is the lunar cycle. And I know that people will laugh at this, but if markets are sentiment driven and the moon influences people's emotions and moods, then it would stand to reason that the cycles of the moon would impact the markets. And it turns out, and I laughed and was skeptical about this the first time somebody introduced it to me. There's a guy on Twitter, I think he goes by Lunatic Trader. I met him probably 4 or 5 years ago on one of Cody Willard's websites. He's actually a pretty good trader, and he uses the lunar cycles as part of his method. And starting on June 1st, we start going into a positive phase of the moon. So we'll see if everybody's mood gets better and we get an early June rally. And hopefully by the end of June, we get a little bit of positive feedback on the trade wars. So, sentiment influences everything. We've been talking about that with the oil stocks, that there's just negative sentiment around them. And the question we ask is, at what point does the true value matter more than sentiment? When do value investors get in there, start buying, start creating some positive sentiment because the stocks start to go up, and then we get a positive feedback loop? I look at the prices of some of these stocks right now, and I can't believe how cheap some of these stocks are. Their financial numbers don't support such low prices. Most of the stocks on our list should be 50% higher for sure, and some of them should be double. So when does that occur? You got me, but it'll probably occur when we feel the worst about it. And if you don't feel horrible about your oil stock investments right now, then you are a stronger person than me, because I'm having a bad year now just because of the oil stocks. Almost everything else is even or up, but the oil stocks are kicking my ass. So, at some point we need to make some money back on those, and then we have to think about something. There's a piece of Wall Street wisdom which says that you don't have to make your money back the same way that you lost it. Keep that in mind, right? So if you're down on a position and it was 6% of your portfolio and now it's down to 4%, maybe rather than adding to that on a dip, maybe you take 2% of your money and put it into something that may be a little less correlated, but in the general same story. So rather than adding oil stocks at this point, maybe you add a little bit of solar. And on our list, our watch list, we're going to have 4 companies in the solar industry. So that is driven by energy, right? Energy prices influence solar. There's almost a direct correlation. It's like 90%. And if oil prices and gas prices go up, that means solar becomes even more affordable. And what have we talked about in the last couple of weeks? We know that solar is basically at the price point right now where it makes sense to build solar and battery and even wind in place of coal or natural gas. So while natural gas is still replacing about 1/3 of the retiring coal power plants, 2/3 is going alternative energy. And as we electrify the economy even more, and that'll happen as EVs gain traction, we'll want some of these alternative energy investments. So rather than adding to oil, which has a limited future, maybe we add to solar and grid storage and smart grid and batteries, which have a much, much longer shelf life and more positive sentiment behind them, because the millennials just simply aren't investing in oil companies. So until there's a huge rally, in which case you'll see the traders jump in, then it'll suck in some other people. Oil is a trader's game, and alternative energy, smart grid, that's really more for investors. So when I take a look at the oil stocks that we have, Occidental is probably the one that I keep. Remember I told you that they'd come out with an announcement at some point about enhanced oil recovery and about CO2 capture. I don't know if I can pull it up quick enough, but what did Occidental just announce? I mean, not 2 or 3 weeks after I said it. Well, Occidental announced this week that they were going to be sucking carbon right out of the air. There you go. Occidental remove CO2 from air, use it to boost oil recovery in the Permian. I told you that it was coming. And here it is. I think when I said this a couple of weeks ago, somebody said it was speculative that would happen. It was not speculative. If I say something like that, that means that it's at least in their back room and then their R&D, and that they're closing in on it. It's the same thing when I talk about Tesla or any other type of technology. I don't pull that stuff out of my ass. I'm reading full time for a living, basically, and I talk to a lot of people, and I think that gets lost on folks, particularly new subscribers. There's a lot coming with technology, and the oil space. When I say there's going to be mergers and acquisitions, I don't mean any small amount. There's going to be major mergers that surprise you. There's going to be mergers of more than 2 companies. I suspect that there's going to be a merger in the Permian between 3 or 4 companies at some point. Maybe they call it Permian Resources or something, and they not only do oil and gas, but they get into water, right? And then they start building their own solar and wind facilities. There are some smart things that could happen with some of these Permian companies, and ultimately, you just have to have one guy with a vision that can convince a few other guys that are greedy, right? So I would expect some amazing things out of the Permian. So where I plan to have most of my money when it comes to oil is these 5 companies. I want the Permian pure plays. I want Concho, Diamondback, Parsley, Centennial, and Pioneer. I already own Pioneer, Centennial, and Parsley. So the question becomes, do I need to buy Concho and Diamondback? I mean, I guess if they got super cheap enough, and I haven't even looked to see if they are, maybe we could do that. But imagine if all these colored spots were one company. They would have some pretty amazing things that they could do. Remember, a lot of this is Chevron, a lot of it is Occidental, and a lot of it is Exxon. So, at a minimum, you're going to see acquisitions, but I think there's going to be some neat mergers. And as we are seeing from companies even before they merge, they're cutting expenses dramatically. Take a look at Pioneer Energy. Pioneer Energy just cut 25% of their labor force because they think they can produce as much oil with less people. I think that they're right. And I think that also opens them up to being a much more attractive acquisition target for a new company to come in and say, hey, you're accretive in the first year, and we're going to give you this big number to buy you out. On the other hand, by having less labor, they can merge with a company like Concho or Parsley or Diamondback, right? Centennial's in here, but much smaller. I think Centennial just gets bought. But these four companies, man, that would be a neat merger. We'll see. We'll see what happens. Chevron could just start eating them all, or Exxon could just start eating them all. All right. So trade war impacted the oil prices. I showed you that headline over at oil price. President Xi and President Trump have been beating the crap out of oil. And if they ever wake up to the fact of what they're really doing to the global economy, they will reverse that. And that would be the positive surprise that I have talked about with the trade war. I think that it is highly unlikely that President Trump really wants to continue going here. He's pushing as hard as he can, and the Chinese aren't going to give until the Chinese get what they want, which is leave us alone and we'll buy your stuff. And that's what they want. Leave us alone and we'll buy more of your stuff. President Trump's going to have to accept that. So if he wants to control technology transfer, he has to control it from our side. There has to be a law or something that tells our companies, hey, these are the things you can't do with China. So when you consider going over there, your deal with them has to incorporate our laws as well, which say that you can't give them technology for free. You can't sign it over. If you want to sell it to them and it's not defense related, so be it, but you have to set a market price. So there are ways to control the flow of technology from America to China via market mechanisms. You just have to enforce the rules on the companies here. It wouldn't be difficult to do, actually, but nobody wants to stand up to our CEOs. They walk on water because they're the best in the world and deserve 600 times more pay than everybody else. That was a little bit facetious. I hope you got it. Hope the Blue Yeti brought that to you. In any case, over here at FA Trader, I really like Eric over here. He's a great analyst. He's a reason, Lynn's great too, but he's a reason to go over there just for the $20 a month because this is the last weekend and that's last week. This is the last week where you get FA Trader for a 30% discount. So I suggest that you jump in, if nothing else, for this guy's macro stuff. His data-driven approach shows some really good charts. I'm going to start stealing these more and more. But we have seen manufacturing fall pretty dramatically here in the last year. A year and a half ago, I wrote an article saying it's Trump's economy now, right? He wrote on the coattails of Obama for a while. And then at about this point, when he appointed his Fed chief and did some other things, got his tax break, I said, okay, now it's Trump's economy. And this is what's been happening. So while unemployment stays low, we just got numbers from GM and Ford. They're both laying off people. There's tech companies laying off people, financial companies laying off people. And that's something that we have to keep an eye on, because if that's more than just churn in unemployment, right, people switching jobs, then we have a problem. Because once unemployment really ticks up, and it goes from 3.9 to 4.1 to 4.5 to 5. Once you get to about 5%, I mean, you're starting to see problems. You're starting to see a lot of slack in the economy. And folks who lose their jobs, about 1/3 of them cash in their 401k. That's a lot of pressure on the stock market. So probably the thing that we watch the most is unemployment. If unemployment starts to go up by more than 1/10 or 2/10 of a point, we have to start asking ourselves the question, how much of that money in those people's 401ks are they cashing in because they have to live? And I can tell you, half of the population is completely unsophisticated about saving for retirement. They look at their 401ks as a savings account, mainly because they have to. And they don't think about retirement until 5 or 10 years before retirement. And I can tell you, as a financial planner and an investment advisor, that is absolutely true. I cannot tell you how many times people in their 50s came to me with a $35,000 or $45,000 rollover and said, hey, I want to retire at 62. And I'm like, well, I try to sugarcoat it for them. What are you going to do about healthcare from 62 to 65? Well, I don't know. You probably have to work until you're 65. So I get those 3 years commitment out of them. And then we do the numbers and we show, okay, even if I'm a superstar and I double your money every 5 years, you're still going to be in the hundreds of thousands. And they think that's a lot of money. And then I explain to them, hey, you're going to live to be 90 or 100. So if you're only going to take out 4% or 5% of your money from your retirement account, and let's say we get it to 400,000, you get $16,000 a year on top of your Social Security, which for a lot of folks is going to be, maybe $24,000 a year, give or take. So now we're talking to them, and I say, okay, so can you live on $40,000 a year? And a lot of them say no. Well, I live on $60,000 because I make $60,000 right now. But you're not saving enough of it, right? So the negative feedback loop that occurs when there's high unemployment is overwhelming. It is usually what crushes the stock market because folks cash in their 401k. So here I will put in my pitch for, you better think about wealth inequality when you think about who you vote for, because it's that important. If you have investments, and everybody on this call does, and you think that wealth inequality doesn't matter, that they should just work harder, that's fine. You can believe it. I believe a lot of people should work harder too. But the reality is that a little bit of medicine, a little bit of, I think I got that saying wrong, right? A little bit of preventive medicine is, better than surgery. I don't know. I have to look up the Yogi Berra quote on that. But, helping folks to not be so poor is actually good for those of us who are doing the right things or trying to do the right things. Because we can't fix human psychology. We can't fix human nature. That takes a very long time. And when people feel under pressure or threatened or scared, that just has so many negative feedbacks that those are the things that at the core we have to fix. Is, okay, how can we help people do better in an economically efficient way? So I'm not talking about fairness. I'm talking about economic efficiency. And some of the things that we do are not economically efficient because we just feel that, well, they should be doing better because I am. And that doesn't work. So let's keep that in mind. So when we look at a chart like this, we should ask, why is this happening? Why is manufacturing falling? Right? Why are durable goods plunging? Durable goods, refrigerators, things like that. Why? Because people don't have the money to buy them. That's a problem. Right? Core capital goods orders. Those charts are pretty self-explanatory, right? They're all falling in the last year and a half, 2 years, 1 to 2 years. Not good. So we have to ask ourselves some pretty serious questions about that. There you go. Let's move on to some of our investments. Talk about the thesis behind a couple of them and how to scale in, just as some examples. So that I've become more constructive on Tesla. I am not some uber bull on Tesla, right? Last November, after a successful trade, I sold my shares. And in here, I told folks I'd refill the position between 150 and 200. At the time that I said that, there you go. An ounce of prevention is worth a pound of cure. There you go. Yeah, I take the Yogi Berra approach. I just kind of remember something was said and make it up as I go. I said that I buy Tesla between 150 and 200. At the time, Tesla was trading at like 345. And folks told me, no way, it can't fall that low. Well, remember our very short list, soon to be called? I'll let you vote on that. Should I keep calling it the very short list, or we just call it a watch list? I put in these bottom fishing prices, and people say, when am I ever going to buy these stocks? They're never near their bottom fishing prices. But from time to time, they do get down there, right? They do get down there. We get stocks that come to us from time to time. Sometimes it's market driven. Sometimes the company hits a speed bump. That's where being patient comes in. Now you'll see in this in our watch list, in our very short list, see a couple people actually asked me, well, you call it the very short list. Are those companies we're supposed to short? Well, to those people who are no longer subscribers, I should have said, read the freaking Getting Started material. So at the bottom of every article now, I say read the freaking Getting Started material. But I'm going to add a support level here. So this is bottom fishing. This is about as low as I think it should go. And when we get to these prices, if we go through the bottom fishing, either A, I was off by a little bit, or B, something bigger is going on. Usually we get these pretty right. I mean, historically, these have been pretty darn good numbers because I'm targeting gigantic support levels. So unless there's really a fundamental problem with the company, these numbers based on the third standard deviation support levels, where the institutions and the value investors come in, have been very good. And if you only shop the very short, the bottom fishing numbers, pretty good prices. You have to be patient because it doesn't always come back in a year, right? We got to rebuild investor sentiment, but you get a good price. So the support level 1 will be more of the shorter term support levels, places that you can buy in for your starter position, or if you already owned it, maybe a place where a pullback might get you a couple more shares, generally within an uptrend, right? So when there's a pullback within an uptrend, you can go ahead and buy. But when there's more falling within a downtrend, stay away. That's the proverbial falling knife. So I talked about why I sold Tesla shares. I said I'd come back to it if it was 150 to 200. And where are we now? We are at 192. So I bought the little starter position up here, right around the 200-day moving average, just in case it would have bounced. It didn't. It just kept on going down. And I talked about, this Tesla really could fall through this floor here and go under 150. It could go all the way back to go, right? Do not pass go, go to jail, go directly to jail, do not pass go. It could. So the bear cases at Morgan Stanley, and I forget who the other one was, but your bears out there putting out these bear cases where Tesla could go down to 56 or down to 10. Sure, if there's a true fundamental problem with the company, and I do not believe that there is. The fact that they've been able to be intermittently profitable should tell you that they are in that jagged period of adoption, which could last a year or two for sure, that they are putting in more capital, but also starting to generate bigger profits on the growth and the increase in margins as their technology gets better, and they only pass on part of that to the consumer and they keep the other part for themselves. Think about what I just said. As their technology gets better and costs come down, they will not reflect all of that in the prices of the vehicles. Part of it will go to the consumer and they will keep the balance. That's a big deal, because that unlocks some huge numbers. So where does Tesla, and I would encourage you to read the ARK Investments scenario on Tesla. Their bear case is my mid-range. So I have a bear case below this, which basically would be if Elon Musk suddenly turns stupid. I don't think he turns stupid, but you never know. It would also come into play if for some reason we did not see an adoption of electric vehicles. As I talked about in the past, Ford and GM have already said EVs with autonomous driving features are the future. That's why Ford just went out and bought big hunk of Rivian, and why GM is spending billions of dollars to ramp up. Now, I happen to think that Tesla is using the right technology for autonomous vehicles. I don't think the LiDAR that GM is using is going to be the one that wins. What Tesla probably has for autonomous vehicles at some point is a 4.5, right? So that means a level 5 autonomous driving is you can fall asleep and it'll get you to where you're going. Level 4 is you don't have to do any of the driving, just keep your feet near the pedals and your hands near the driving column, just in case you have to react to an emergency, right? That level 4 is coming, and it's coming quickly. Next 3 years, probably, maybe 4, could be 2. They say 2, so I say 3, and maybe 4. So 2, 3, 4 years, we're gonna have cars where all you have to do is be there in case there's an emergency. The level 5, where you can fall asleep or do something else, I'm not sure when that comes. That could be as far as a decade off, 15 years, 20 years. Maybe they never figure it out, right? Like nuclear fusion. The theories are there, but they can't make it work. What I think Tesla gets to versus what GM and Ford are on pace for, I think Tesla gets to like a 4.5, right? Where you probably can go to sleep, but if you crash and die, you shouldn't sue. Nobody should sue because you fell asleep. So I think that the 4.5 level is coming. I think somebody else who's got more digital cred than me is going to come up with a AV 4.5. Maybe I'll put it out there in an article real quick, see if I can monopolize that. But Tesla's ahead, and their market share is about 17%. So even if their market share drops by a third, which I talked about a few weeks ago, right? I said, let's do a bear case and let's take away a third of their market share. Well, ARK Investments just wrote this. If its market share were to drop by a third to 11%, right? I'll pull this stuff out of my dog's food dish. I don't want to say ass again. These are things that I think about. Where are these things going to go? I'm telling you, the bull case on Tesla is so high that it's not even worth talking to you about. Seriously, it's not. Go ahead and read their report, read their bull case. I have more bull things than they talk about, but read theirs. The bull case on Tesla is a stock that goes well into the thousands. So the next article I'll write on Tesla is going to be titled, "Here's why Tesla can go to 1,000," or "Tesla is going to 1,000," just so I get more people to read and be mad at me. Does that mean that Tesla can't go to $100 a share first or $50 a share first? It doesn't mean that at all. But this level between 150 and 200 is a big level. There's huge support in this range. This is where I'm starting to scale in, right? So I told you I took my starter position up here because it was the 200-day moving average. And a lot of times, it could have very well bounced off of there. That was a pretty decent level, but not super strong. This is where I've traded out of one other time. So I bought down in here before. So today, I bought just a couple of shares, nothing much, just a little nibble. So I'm in at 255. 260. I'm in again at like, I think it was like 193 this morning is where I got in. Will I buy again? Yeah, I'd probably buy again in the 150 area. So I didn't buy, I didn't buy this dip. I didn't buy this dip. I didn't buy these dips, right? People who say they're scaling in and they buy here and here and here and here, what is the difference in price here? There's no point in scaling in there. There's hardly any difference in price. I bought in here. I bought in here. It's a $60 difference in price. 25%. 20%. That's how you scale in. Okay. I am not buying any calls on hardly anything right now because I think that unless you're trading a specific event, which is not a margin of safety thing to do, but it could be a fundamental trends thing to do. Unless you're trading a specific event or an incredible oversold condition with a catalyst. Not just oversold, but oversold with a catalyst that's near term. That's when you buy these calls. So you have to have multiple reasons to buy a call. So when I learned how to bowl, right? You see the connection, right? When I learned how to bowl, my dad taught me how to roll the ball. And he noticed that I was already cupping the ball and throwing it with a hook. He was like, okay. And my dad was a good bowler, amateur bowler tour here in Wisconsin, won a couple bucks, 2-something average, low 200s, which is about where I got to at one point in college when I bowled there. And he showed me the different angles on the lane where to throw my ball. Because I just, I wasn't really thinking about that. I was like, hey, I throw a hook, and I guess where to throw the ball. And he showed me different angles from the inside, from further inside, from the outside, less hook, more hook, right? How close do you get to the gutter? And he showed me that you want more ways to win, right? More ways to get that strike. You don't want to have to throw the perfect ball into the pocket every time to get a strike. Sometimes you can come in a little bit high, but if you have the right speed, it'll bounce off that other pin. You won't leave the 10, right? If you come in real high, you might get a Brooklyn, right? You might hit it. You might just get one of those strikes that looks funny, but they all go down anyway. You want multiple ways to win. And when you buy calls, you should not be buying based on one idea that has to work. You should have a few ideas that somehow in some combination could work for you. One idea does really good, and even if the other one doesn't, you just get a bounce back on an overbought stock. Sometimes it happens, but usually it takes some sort of news to get that V-shaped recovery, which is what you need for calls, right? For shorter term calls. And one of the evolutions in my thinking is, and it took me a while because they make so much sense in theory, but when you take a look at the prices, leaps make less and less sense to me because you're paying so much for the time value. So it turns out that rolling your call positions quarter to quarter tends to make a lot more sense. Financially, it's cheaper to do. So that's just something that you want to keep in mind as you scale in. So where would I buy calls on Tesla? I'd probably buy calls down around 150, right? Because at that point, I have to believe that there's just so much freaking pent-up support that this is an emotional reaction and that we get that V-shape. Look at that. That's beautiful, right? If you had traded calls in here, you got your butt kicked, right? And unfortunately, some of the oil charts look like this, and it's pissing me off. But, you don't have to make your money back where you lost it. I think Tesla's a position that you should build. Make sure it's consistent with your risk tolerance and asset allocation that makes sense. Maybe it should only be 1 or 2% of your portfolio. I'm going to probably get to the 4% point, but I'm not there yet. I'm way below 2% on Tesla. So And a way to cheat on owning Tesla is if you want to have a core position in a couple of ETFs, which we'll talk about as well this weekend. Take a look at your core ETFs. What do they hold? Right? This ARK Innovation Fund is a great fund. And I'm going to compare it here to QQQ, which we know beats the heck out of SPY. We're going to take a look at ARKK. Take a look at different time frames. Right? This ARK Innovation Fund does pretty good. Now, over the 1 year, it's a couple points below. And it's driven mainly by Tesla. So you might want to buy this ARK Innovation Fund or their ARK Web 2.0, which I like. I like this this green one. It's beat the shit right now. It has different companies in it, and it doesn't really include biotech. It doesn't include biotech. So the ARK Innovation Fund includes the biotech, and companies like CRISPR, which Bhavnish has been talking about over at FA Trader. And I think that these are funds that you should consider, because over the slightly longer term time periods, you can see these ARK funds do pretty darn well. And if you can buy these on pullbacks, right, they're higher beta. So that means that they're going to be more volatile, right, higher beta. So you can get these at oversold spots against the market. Next week might be one of those spots where you may want to add a little bit of QQQ, but you may want to add some ARK Innovation Fund. And if you really don't want to have a lot in biotech, I have a hard time with biotech right now. I just think the whole healthcare industry is going to face problems. So I'm more in this ARK Web 2.0, X.0. I like what they're doing. You take a look at their top holdings. It's also NVIDIA, Tesla, Twitter, Square. I mean, you notice some of these companies. This is really the only one I don't like. I just think Netflix is going to face a lot of competition from Disney and AT&T and whoever buys or gets right to the Sony library. But you take a look at this, you get a little bit of your China exposure. PayPal's been one of our darlings. Twitter, I talked about, and then I didn't trade into it. But this is a way to have a nice little core holding, 6, 10, 12% of your portfolio maybe, if you're going to still be buying stocks. If you're going to be a purely ETF investor, I think this could be a quarter of your portfolio. So, think about this fund. I'm going to have articles, ETF file articles on these funds soon. We already talked about Occidental. If you're not buying Occidental, right there, right? But it looks kind of like that one. See, I thought it was going to jump here. I was wrong. Now we're way down here. All time, well, 10-year low. 10-year low. So the question you ask when a company gets this oversold and nobody loves it is, are they going to stay in business? And there is no question that Occidental is staying in business. So with them being cash flow accretive on the Anadarko, with them making the announcement on the CO2, which I mentioned CO2 in a Kinder Morgan article too, it's something I've been studying. What's going to go down with Occidental? If nothing else, they're just going to start buying back a ton of shares, and they're going to pay out a fatter and fatter dividend. At some point, people go, Jesus, look at this dividend. It's 6%. So with a 6% dividend, even if the stock price never ever goes up, you still have a double on your total return in 12 years. And they're going to be doing natural gas, and they're going to be doing CO2, and they're eventually going to get into water. Something to keep an eye on in the Permian. As the oil drilling goes down, they're going to be able to unlock some water resources. 10 years from now, water resources might be a lot more valuable. Keep that in mind. So I like Occidental, and man, if I could see some of these Permian companies merge, you might get a super company out of that. Something we've talked about over fundamental trends, and I'm not going to give you the reasons, but we're talking about a short on the German ETF right now, and there is multiple catalysts. One of them has to do with one of the largest holdings. One of the catalysts has to do with the trade war. We're not doing it now. We're waiting for a rally. And if this rallies up into that 70 range on the RSI and everybody starts to love Europe again because maybe there's a little bit of softening on the trade war or maybe the impacts aren't as bad. Right, it might not happen. But if we get a rally, we get up to around here, 30-ish, 28-ish, 29-ish, 30-ish. There might be a reason to buy puts on the DAX index. We'll see. I just put out a couple of little 30-second voice notes, which the chat over at Fundamental Trends allows me to do. It was actually kind of cool. The first time I did it today. I'm not signed in. I have this set up to make you sign in almost every time you go to the page. Sorry about that. It has to do with security. It has to do with the way the cookies work. So hedging, I put in a couple of voice notes for you to listen to. They can only be 30 seconds, so they're quick. They're sound bites. But we talk about why we might buy puts on DAX at some point. Very short list I'm updating. This is just the guts. I've been using the existing copy to create the guts. And once this is completely redone and I add this support level here, I will put it into a new spreadsheet, host it in a different spot, and then you can apply to use it, which give you the ability to download and everything else real nice. Don't really want to talk too much about Qualcomm, but you see, look at this chart. News, different news. If you're invested in a technology company, you kind of have to know if there's anything big that could be going on. Different lawsuits, right? This is the Trump trade thing. This is the lawsuit. They might both be lawsuit. I don't know. But our bottom fishing on Qualcomm is 51. People say, well, it never gets to 51. Sure it does. Got there here, got there here, got there here. Look at this support level, right? Once it broke through there, it's been a very strong support level right around 51. And I always set my bottom fishing just a little bit above the support because we want to make sure we get in, right? But if Qualcomm drops down into the low 50s, yeah, eat it up, right? Just back up the truck because then it's spitting out that dividend. That's the price at which the bad news doesn't matter anymore. Dividend would be well into the 4s. But yeah, if you can get Qualcomm in the low 50s, have at it. Their technology is super important for 5G. So one way or another, they're going to be part of the future. It's just what price can you get them at? Apple, same thing. What is our bottom fishing on Apple? 150. Did it get there? Yep, just barely got there, right? And I set that bottom fishing way up here. We got there. I think we probably get there one more time, but I think that this line holds. So if Apple gets into the 150s, again, probably back up the truck. They have the biggest piggy bank in the world, and their hardware sales are going to stop falling. So everybody's talking about how the iPhone is going towards replacement cycle and saturated market, but Apple is moving into the enterprise space, into the business space with their iPads. There's going to be an awful lot of corporate business that goes towards the iPhone and the iPad because they work well together, especially companies that already need something better than a PC, and the Mac is for sure better than a PC. They're going to pick up business there. The other place they're going to pick up business is services. And when you're selling hardware to companies, you get service contracts, right? You get recurring revenue. So I think that Apple is probably a good buy down in the 150s. All right, a couple of questions. How much Oxy do I have? 4.5%, 5%. That account, it was 1.87% in the growth portfolios. Yeah, about double that in the dividend portfolios, about 3 to 4%. I think it probably started at 5 or 6. Does Apple buy Tesla? Highly doubtful. Highly doubtful. They could. I mean, does it make sense for Apple to buy Tesla? Man, there's a lot of reasons why it does, right? First of all, Apple all of a sudden could sell Teslas to basically every iPhone and iPad user because everything integrates. They'd still want to have a car that isn't purely controlled by their software, though, right? Or would they try to close off the system? I don't know. I'm not sure. I think Tesla's already on its way to doing its own thing with its own, market. I don't know. I don't know if it makes sense for Apple to buy Tesla, and I don't have any idea what the price would have to be. It would have to be a big number, right? They'd partially be buying Elon Musk as a successor to whatever his name is, Jobs 2. So we'll see. I doubt it, but it could happen, I guess. All right, call it a day. Under an hour. Fantastic. Have a great Memorial Day weekend, and keep an eye out for the new. Looks like we have one vote for VSL. Keep an eye out for the new VSL, which should be out on Memorial Day, and try to remember back to days when we had free trade. All right, yeah, I don't know what the price actually is at FA Trader, so go ahead and take a look. All right, have a great weekend.